G'day, it's Scotty from Zim Real Wealth, and tonight is our August 2019 live Q&A. So it's our live property market Q&A. You can ask any question that you want about the property market or anything in particular related to property. So we have our webinar running for our Zenium clients, and tonight we're trying something new over here on Facebook where we're live streaming as well at the same time. So if you have any questions either on our webinar or on our Facebook page, drop them in the comments and we'll answer them live right now. We've got 30 minutes and actually we've got 29 minutes left now, and we'll kick off with some questions that have come in today. So what's the first question we got there, Jace? Okay, so this is relating to our webinar last week where we talked about some positive cash flow properties, and one of the properties styles that we talked about was rooming accommodation. So the question is, can you explain how rooming accommodation works? Are there any potential issues with financing and valuations? All right, so rooming accommodation is essentially a room by room let. It's not anything new under the sun. It's been around for many years. And it's been in one form or another. You might know it as student accommodation or boarding houses or so on and so forth. So rooming accommodation, I guess, has taken a new form nowadays with the emergence of Airbnb and other things where like-minded apps, where essentially those properties are rented either partially or room by room. So that's how the whole term rooming accommodation works. What we were talking about was specific rooming accommodation. It wasn't Airbnb. It was to do with more semi-permanent rentals. And we were talking in the capital cities where there are shortages. And we have a great contact, Michael, who does this for a living. And what he does is design houses specifically for a certain market, and they rent very, very well. So it works because there's a common area that they have access to, but there's individual locked rooms that is actually yours, and yours, you're right? You rent that room. It's locked up. It's got your own stuff in. It's got a little kitchenette. So it's like a really small apartment with a group of some others. So that's how it works. Are there potential issues with financing and valuations? Like anything, the valuation and financing is going to take the lower amount of any sort of figure. So if it's valued at a 5-bedroom house this way, or with the cash flow of rooming accommodation this way, they're going to take the cash flow on the 5-bedroom house. That's just how it works. So there's not really potential issues with it. It's just that you probably won't necessarily be able to get finance based on the rent return straight up, as you would with, say, a commercial property or something like that. After there's proof of concept in 12 months, you could do that, and you can go back and refinance based on the rental return. But at this point in time, when you're building them to begin with, it will be based on the equivalent of a normal house and net rental. All right, next question. Okay, auction clearance rates in Sydney picked up last weekend. Is the slump over? Okay, excuse me. So I've seen some pretty positive data coming out of Sydney as well. Is the slump over? I don't think the slump's over. I think that there's always a pickup as we come to the end of winter and early as we enter into spring. Is it an anomaly? I think it's too early to tell. But I can 100% guarantee that we are not at the peak of the market. So I can't say that we're at the bottom. I can't say we found the bottom, but I can tell you that we're not at the peak. Okay. So is the slump over? I'm not about to call that. However, we did say as we moved into 2020 that we really thought that the bottom would be found in the market, especially those Sydney, Melbourne markets. Are we there yet? It's probably too early to say, but that's what our opinion is from early this year, and it hasn't changed. Next question. Okay, so this relates to our webinar last week again. It says, what is a dual key and is it better than a duplex? Okay, so a dual key property, the best way to explain it is a house with a granny flat attached. Okay, so they look pretty nicer than what you're thinking in your head on that. They essentially look like a nice home, and it has the added bonus of having a granny flat attached to it. They're a very specific market. I think that there's definitely some exit strategies around the dual key market, so they're not just stuck in there as a typecast style product. But is it better than duplex? It's different to a duplex. Generally, dual keys have a higher cash yield, but you can't separate the units. So if you've got a 3-bedroom house one side and a 1 or a 2-bedroom unit the other, you can't ever separate them on separate title and sell them off. They're always going to be the one property. So if you're bought it at a 6.5% yield, there's a good chance you'll sell it at a 6.5% yield. So a bit like commercial property, if the rent goes up, then you sell it back on that same yield, then your sales price will increase. Where do they work? They work literally as a granny flat. So say there's some elderly people in your family that you want to stay with. Maybe it's an elderly parent or something that you want to be near the grandkids or whatever. You can have that sort of that arrangement. It works with a family who rents out the granny flat to help with cash flow on the property to someone completely independent, because they are separated and you can have the yard separated. It also works the other way, where you could have, say, first homeowners in the granny flat and they're renting out the house side. So they work for investors, they work for owner-occupied and literal granny flat style situations. Better than duplex, they're different. So duplex, you can sell off each individual unit once they're strata titled, and therefore you can build 2 and keep 1, build 2, keep 2, sell 2. Okay, so it's a little bit more dynamic in that. They generally have a lower yield, so a lower rental return, slightly lower than dual key, but they're more dynamic in their exitability, and you can carve them up in half. All right. There's a Sydney buyer's agent that has seen a dramatic increase in inquiry in the past 3 weeks. He didn't know we're saying we've passed the bottom, but he's certainly very encouraged by the rise in sentiment and activity. Okay. I think that's a comment more than a question, but that's good to know. Yeah, that's the same data we're seeing with auctions and time on market and amount of stock on market in Sydney has changed. Sydney's the biggest market. It's not all about Sydney, it's just it's the biggest market, okay? So it's the one that everyone kind of gravitates to. All right, is there another question? What is involved in strata titling a duplex? Is it expensive? Strata titling, it depends on council to council. So there can be a variance in costs of anything, say from $8,000 to say 30 grand. In essence, as long as the property was built to be able to be strata titled, and all modern duplexes have to be like that. So there's fire walls down the middle of the two dwellings, and they're all set up with separate water and power and all that sort of stuff. Then it's a relatively straightforward procedural process. So it's not something to be scared of. And in our projects, when we do duplexes for clients, that's part of the process that we go through. Unless the client specifically says, no, we're going to keep this long term, I don't want to strata it just yet, then we always strata it in preparation for sale in our 12-month process for the client. All right, next question. Okay, when are we offering our next project to Xenium members? Okay, so we've got some projects that are already on the go now. We've talked about in previous webinars. There's a variety there. So we've got everything from our normal development projects down to what we call our micro projects, which is our duplexes and 12-month program with clients, and things in between. So we have 1, 2, 3. We've got four or five projects that we can offer clients at the moment, and as well as we have 4 different duplex options right at this point that some clients are looking at, and of course wanted to know more of. Because with the duplex, I don't know if you're not aware of that, how it works is that we come in, we secure a block of land and we build the duplex. Obviously, we've done the research to make sure it's in the right spot and what have you. And then we go through the construction process. We take that to market. At the end, we get a tenant. And then once that tenant's settled in, we actually put that property on the market for sale as long as we make sure that the sale is after a 12-month period. So in that process, we have a target aim of approximately 10% of the duplex total construction cost is what we look to aim for as a net return for our clients. So to break that down in simple terms, if the house and land package of the duplex and everything else turnkey costs $700,000, then we aim for our clients to sell it in 12 months' time and make $70,000 that they can take away in their hand. Okay, if it's $800,000, it's $80,000. You get on. That's the 10% margin. So that's on the duplex mini projects. We move up to duplex group projects, which is a 15% return on their monies, and then we move up to development projects, which range between 12 and 18%, depending on the developer and what they're offering. So those projects are available now. If you're interested, you can tag us on the Facebook feed or in our webinar as we speak. You can always hit us up at hello@zenium.property. So there's no .coms, no .aus. It's hello@zenium.property. All right, next question. Someone's into duplexes tonight. Okay, some duplex sites just don't seem to work. What are the factors that you look for to create uplift? We always start with the final sales prices. There's not much point starting a project going, oh, look, I've got this land cheap and I know a builder and he does a good job. And then you get into it and go, okay, so we've done that. We've got a tenant. Now, what can we sell it for? It's a bit late. It's a bit late at that point to be doing that sort of stuff. So you have to start, obviously, beforehand. Now, you can't always know exactly what the future is going to hold in a 12-month period, but you can definitely base it on figures at this point in time. So if we go in and we've got a live example that we showed last week where the duplex would cost around about 700, so land, let's call it land 300, build 400, we're rounding figures here. And then the sale price was $415 a side, so $830 minus sales costs is $800 minus some strata fees and some interest costs would be down around that 10% margin, that net margin based on the duplex cost. So you've got to work it back that way. So yes, not some duplex sites don't work. A lot of duplex sites don't work. In fact, there's a lot of home sites that don't work, and there's a bucket load of development sites that don't work. You absolutely need to look for the end sales value. And when we create uplift, there's limited things that you can do, but if you make it, right for the block, or, there's some strategies that we use in the sense of, we like this 10% figure. You want your duplex to be roughly about 7 to 10% below the equivalent house price. Otherwise, they're just going to go and buy a house. So there's those things that you need to be aware of when you're pricing your duplex project. Next question. Excuse me. The media is talking about the R word, recession. Given the US and China trade deal standoff, the Aussie dollar hitting a record 10-year low today, the share market instability, auction clearance rates seem to be up all around the country. What are your thoughts on the property market, I'm assuming? Property. Okay, so essentially the question is, the media is saying that we're possibly in a recession, the US and trade deals big, Aussie dollar low, share markets all over the place, but auction clearance rates are up, and the property market in general, how's it going to react? Is it more robust to these events in general? All right, that's a really big question. Essentially, well, the media is always talking something up or down. I mean, does it really make any difference? is when the property market's going up, it'll talk up. When they feel like talking it down, they'll talk it down. When it's going down and it should be talked up, they're still talking it down. The media just goes wherever the media goes to sell headlines. There's a lot of superficial media in the sense of, this has happened, so therefore this is happening. It's like, at the end of the day, it always comes back to the property market being in balance of supply and price. Now, it's not supply and demand, it's supply and price. So when there's too much supply, prices go down. When there's not enough supply, prices go up. It's as simple as that. Now, demand line sort of stays in there, but if the markets start getting talked down, then what happens is it makes it harder and harder for new projects to come on, so the supply chain starts drying up. If the supply chain dries up too quick, or didn't need to dry up at all, then you're going to end up with a supply shortage. So it doesn't matter what's going to happen in the media. If there's a supply shortage in a specific suburb or town, then you will have price rises. There's no other way around it. It's because the gains are always capitalised into the land. So I'm not about to say that there is a recession coming or there's not a recession coming. I'm not even going to begin to presume what President Trump will do. But I think you need to look in the areas that you're working in, and you need to study the areas you're working in and see what that supply and price correlation is in those areas. You will see weird things happen, because if there is an undersupply, then you will see auction clearance rates increasing and time on market reducing. That's just the sort of things that happens. Do I think the property market is more stable than share market? Yes, but only because you can't transact it as quickly, right? The share market is simply an extension of people's emotion and ability, just like the property market is. The problem is the property market is absolutely painful and slow to transact. It's not like you can just flip a property, you buy it today, right, I'm going to sell it tomorrow, right, I'm going to buy it back on Saturday. It just doesn't happen. And that's why the share market does what it does. The property market has to be slower, or has to be more stable, simply because it's slower. Now, if you could transact property like you could shares, would it be different? Quite possibly. It may well be. But with everything in place, that's not necessarily the case. Now, we've got a question on Facebook there. Karen, can you chuck that? Can you see that question? And you can chuck that in here if you can. Jason, is there another question we got there? All right, let's have a look here. Sorry if I look weird. All right. Okay. So Michael on Facebook. Hey, Michael, how you going? A lot more people are talking about recession, and now with social media platforms and ease of communication, a recession could be self-fulfilling. Yeah, look, thank you. Not a question. And I agree with that. I very much 100% agree with the speed and velocity of the amount of information that goes on. There was a report, I don't have it to hand because I didn't know I was talking about this. There's a report I read a couple of years ago that actually said that everybody is so much better off now, and here's the data that proves it in Western society. And that was at a time when, with terrorist attacks and other bits and pieces, people thought it was the end of the world. When you actually break down the data, it's a lot better. What happens is that we hear about things now sooner, more often, and with more ferocity than we ever used to do. We never used to hear about things in other countries as much as we do now, or even in other states and towns. So, yeah, absolutely. The way that communication happens can create a self-fulfilling prophecy, so to speak. But we'll wait and see if that's going to happen. I still maintain that according to the property clock, we're at a mid-cycle slowdown period. All right, Jason, any other questions? Can you explain where I, as a potential investor, sit in relation to the security of money in a land subdivision project? Okay, all right. So this is in relation to our webinar last week, again, where we brought up one of the land subdivisions that we brought to the table. That one in particular, and actually all the others that I've mentioned this evening, there's always a bank first, and then property partners second, and then the developer goes third. That's the order of money. You can't get around the bank being number one. Banks like being number one. Who doesn't like being number one? Well, banks are very good at being number one, and they make sure that all the documentation says that. But at the end of the day, we have to work with what we've got to work with there. But the partners are number two behind the bank. So that's where you sit in relation to order, in relation to security. Well, it's a preferred equity or C, depending on the project that you're talking about. And there is an unpresented second mortgage that goes with the group of partners that are involved in those projects. That's probably like a really quick version, and it is project specific, and I can explain that to you one-on-one, or Jason can on a call or a chat or whatever. All right, next question. Brisbane and the Sunshine Coast are at opposite sides of the HTW clock, with only 1 hour travel time between them, literally 1 hour, not on the HTW clock, obviously. How is there such a big difference? Okay, so the HTW clock is a clock that we talked about last week. We always talk about that in the middle 2 weeks of our Xenium program. And this month, Sunshine Coast is at 12 o'clock saying peak of the market, and Brisbane is at 6 o'clock saying bottom of the market. So with only 1 hour travel time, how can they be so different? Well, they're completely different places. Okay, so they're totally different. I mean, Brisbane is a city. Sunshine Coast is a regional hub. Sunshine Coast has tourism and lifestyle and other bits and pieces. Brisbane is the city with infrastructure and other, money, finance centre, all that sort of stuff. It's the third largest city in Australia. So even though there's only an hour difference, they're totally different. They're not the same thing. They're not even close to the same thing. So that's how there's such a difference. There's a real difference because whilst the Sunshine Coast has infrastructure and has done so the past 10 years, there's less of it than what's spent in Brisbane, simply because there's more population in Brisbane. So if HTW have the data that say that according to prices and time on market that Sunshine Coast is sitting towards the top of the market and Brisbane is towards the bottom of the market, well, then that's what their data is going to say. So that's their interpretation of it. What we do is we take their data, we review it, and then we will look at how we act in those markets accordingly. All right. We got here, sorry, I'm leaning this way. We've got some more questions. Okay. Rents going up will bring the next phase of growth. Will we have a rental crisis in 3 years, right on time for the next growth phase? Thanks, Michael, again on that. I'm not so convinced that it's going to be 3 years for the next growth phase. The reason is that we have real pockets of oversupply, I think apartments currently, but that doesn't mean we've got oversupply in other areas. So just because there's apartments vacant, so I've got 4 kids, we're not a particularly massive family, but we may be larger than some other families. But just because an apartment is vacant doesn't mean that it appeals to me that I can even live with my family in it. So one style of property having an oversupply doesn't necessarily mean the whole market has an oversupply. The reason I'm saying that, Michael, is because that if this downturn has happened predominantly because of apartments, does that mean the whole property market is going to be stifled or stuffed just because we have an apartment oversupply? And if that's the case, is it really going to take 3 years before the next growth phase happens? As I said in February on my YouTube video where I got crucified, we have always maintained that by middle of 2020, the bottom would have been had in the markets, in the great majority of markets in Australia, and that we would be on a run again. And it looks to me, as the way the data is being presented and all the different data sources coming out now, that we're probably very much on track for that. All right. Any other questions there on Facebook or on the webinar? How are we going there for time, Jace?
We've got a couple of minutes left if there's anything else you wanted to cover.
Yeah, look, I had one on the other Facebook page today about our impact investing strategy. We mentioned that last week. So impact investing was, you know, I don't have it in front of me to share, so because we're just talking tonight. But impact stood for invest money from projects and active capital transactions. So what we do with that is, that means that a client comes to us and says, "Oh, I got a couple of $100,000 to buy an investment property or to do something in property." We say, "Okay, we can go and find you a property and do that, or we can do this," and we can use our impact investing methodology. And with the impact investing methodology, what we do is we take that money, and it's always in your control, right? So it's not like we take that money. No, we say, "Let's look at this strategy." So the strategy would be, say, that duplex we talked about last week and I touched on earlier tonight, that was, say, a $700,000 build, okay? So with your $200,000 and you do a 20% down deposit, 80% lend, we do a duplex construction. Find the land, do a duplex construction, and we get that all put to bed, right? That will take approximately, say, 8 months. We get tenants. There's another month or two. They're in for a few months. We put it back on the market for sale in 12 months. As I said before, that exact example would sell for a little over 800,000. So minus sales fees, 800. So there's 100,000 margin there. We've got strata title fees and interest, and we've rounded that down to about $70,000 net margin. You pay your tax on that, right? You sell those properties. You come away with your $70,000. You pay your tax on $70,000, but you still have your original $200,000 that you went in with the project, right? So if your tax is, say, 30% on that, you're going to come close enough to, say, 50K. So now you've got $250,000. Okay, you got your original 200, and you've got your new 50. So what do you do with that 50? Well, that 50 you can either put on your home loan, pay down debt, or put it aside, and that's what you're going to do. And you're going to build that up if you put it aside, and that's the money that you use to buy and hold property with. Okay, so you always have your original capital that you had, and then you cycle that round through mini projects and other bits and pieces, making money from your money, and you're either paying down your home debt or you're buying discounted properties with the money, the profits that you're making. Okay, so you're always keeping your original capital, your powder dry, so to speak. And the reason that we do that is because if you tie up your capital in one property, you've got to wait for the market to act and to do what it does. And that can be a long period of time in some places. Whereas if you go in and you strategically transact, okay, with active transactions and using your capital in an active way, then you can cycle it around in 12-month periods, right? You go in, you go out, you go in, you go out. And yes, you pay fees on the way in through stamp duties and what have you. You pay fees on the way out through sales, all that sort of stuff, sales comms. But that's why we run it that way. You run it as a mini business, and it's making money. Your money is making you money in the property market. That money is building up your deposits, and those deposits are going to be used for discounted property in those discounted markets or paying down debt on your home loan. That's it. That is our impact investing strategy. And the reason it's that, so we're saying invest money from projects, right, and active capital transactions. That's what impact stands for. And that's why it is so powerful and actually makes a real big impact in your portfolio and your wealth creation. And so that, with that being said, we're coming to the 30-minute mark. I'd like to thank everybody for logging on to the webinar tonight. And on Facebook, we're trialing our Facebook Live there, and it's really awesome because I can see myself in two places at once. That's just amazing, this technology. If you've got any questions, feel free to hit us up on the Facebook page or on email. You can email us at hello@Xenium. That's Xenium, Xenium. So Xenium with an X. Xenium.property. Okay, no .com.au. It's just hello@Xenium.property. We'll come back to you with an answer, or put your number in there and we'll give you a call straight away. That's it from me tonight. Make sure you join the Xenium program, because you get updates like this. We do these webinars once a week. Currently it's Thursday nights. We may change it depending how it goes, if we like mixing it up and spicing up life a little bit there. And we do this every month. We do a Q&A, we do a special guest, we do our market update, and we do our opportunities every month. And this month is a special month because there's 5 weeks in it, which means that we have a special training session next Thursday night, and we'll actually train you on one specific strategy that is something we've been asked a lot of questions about this month. We'll do a sit-down, in-depth session just about whatever it might be. And so far this month, we keep getting asked about structuring. And so it could very well be about structuring and how to structure finance, how to structure your companies and organisations and that for buying property. But stay tuned. We'll let you know what that is probably Monday next week. Okay, I'm going to sign off because I kept you for 1 minute too long. This is Scotty from Xenium Real Wealth. Thanks for joining in.